Welcome back to Minecraft Wealthbuilding. Block by block, I'm building a world while discussing how to grow wealth and build strong systems around investing, spending, saving, and more. The idea is to every week discuss personal finance topics so we can grow our finances together, while I play and grow Minecraft world to illustrate the power of consistent compounding over time. This week we're going to cover a few things. Some recent news on SpaceX IPO, also known as an initial public offering, as well as prediction markets and a recent Wall Street Journal expose article on Polymarket. Then I'm going to recap a core curriculum article I recently wrote on my Substack on who actually serves young investors, or rather, who doesn't serve young investors. Then I'm going to talk through an idea I've been sitting with, and then run through what's going on in my actual portfolio. SpaceX, Elon Musk's rocket launching, satellite internet company, and AI/Twitter, now X company, went public on June 19th at $135 a share. It put its market value, or market cap, at over $1.7 trillion. And on the first day of trading, it closed at $150 per share, a significant gain which pushed Elon Musk to being a trillionaire. This week, SpaceX dropped over 16% on Monday, June 22nd, after the company began pitching a bond sale to raise money from investors this week. They're borrowing more money after they just raised tens of billions of dollars from their initial public offering. And the valuation is crazy. They're trading at roughly 90 times their sales, not earnings, sales, which means at the current market price of the company, their total market value, it would take 90 years at their current revenue rate to even create the value of the total company just in sales. That's not including expenses or employee salaries or other costs of running the business. It's very, very expensive. That's why I don't buy initial public offerings. I'd rather wait and see how they stack up after a couple quarters of reports and a good, decent history on the company before I make any investments. I don't buy IPOs, and well, you can maybe expect a huge return because after all, every great company had to IPO at one point. It's just not for me. Now moving over to the Wall Street Journal investigation of Polymarket, a prediction platform that does not function like a traditional gambling site, but instead matches bettors or users with other users to make trades that resemble gambling, like how the weather will react, how interest rate decisions will be handled, or in the Wall Street Journal's investigations case, if President Trump would publicly say the word McDonald's. The Wall Street Journal interviewed George Macarra, which I'm sure I just butchered his pronunciation, a college student who made $100,000 on a wager that the president would say McDonald's. The bet was one of 145 that George appeared to place on Polymarket's website between January and mid-May, and based on all of his videos, he made up to about $410,000, getting many views on social media and I'm sure enticing many new users to sign up for the platform with the hope of making a lot of money themselves. But on Polymarket's actual site, more than 50 accounts made that McDonald's bet in January, and all of them lost. So how can that be? Is Polymarket making something up? Are they having an error in their systems? Well, according to the Wall Street Journal's investigation, Polymarket was secretly paying George thousands of dollars to make these fake videos and then not disclosing the payments. In fact, the video is completely fabricated. And that's not just a one-off incident. The Wall Street Journal investigated 1,100 videos by 10 creators who made short content from December 2025 to mid-May of 2026. And 70% of the videos the creators placed a bet, and in the videos shown, none of the bets were real, almost $2 million worth, creating an atmosphere where people expect to be able to win lots of money on these prediction sites, when in reality, none of the bets were actually happening, and in fact, people who actually made the real bets that those trades are made off of were actually losing money, like in the instance of the McDonald's bet. In fact, in some of the videos, the URL for the website was actually spelled with a lowercase I instead of an uppercase I to obfuscate the legitimacy of the trades. But moving beyond the fake advertising and the terrible social media campaign that Polymarket has represented, prediction markets, which are simply gambling platforms, are terrible for investors, specifically young investors. Polymarket, Kalshi, and other gambling platforms, as I'll call them, specifically target young men because they know that the next generation of investors feel hopeless on the future of the economy, whether that's due to actual real life experiences, having a hard time getting a home, lower wages than expected after college, or other real life factors, or simply social media bias and potentially misinformation. Young people think that the economy is not as strong as it used to be and are more willing to place bets, quite frankly, gamble on the future so that they can have a chance at financial independence and having the money to buy necessities. Prediction market platforms like Kalshi and Polymarket trick users through advertising, specifically the young men that I was talking about, as they target that demographic the most, into thinking that they have an advantage, especially in sports betting, which is one of the highest ticket areas for these platforms. They make people think that because you have a deep understanding of a sports team like the Red Sox or the Yankees, that you actually have a chance of winning more than 51% of the time on these platforms. The reality is that nobody knows. Players can have a sprained ankle, or in the case of Trump saying McDonald's, unless you have access to Donald Trump himself, which would be insider trading, you don't know what he's going to say. It's extremely risky, and you might as well just go down to the gas station and get a $5 scratch-off ticket, because that's the same likelihood of winning on any of these prediction markets over time. Any investor or anyone who says that they're an investor and uses these trading markets is really just trying to scam you in some way, sell you a course, or get your referral link. If it's just simply not possible to consistently make money in these prediction market platforms, as it's literally gambling and you do not have any control over the future because the world is random, and unless you have insider information, which would make that a federal crime, you're just not going to be consistently profitable. But hey, if you're just looking to burn money, I'll put my Venmo in the description and you can send it to me, and I'll definitely burn it in my backyard for you and definitely not invest it and actually make a consistent 10% annual return in the S&P 500. No, I'll definitely just burn it for sure. What's new and flashy and being marketed the most is not usually what actually works the best. There's a reason why these companies have to advertise their services fraudulently. They're trying to attract as many impressionable people as possible to pay the fee for every transaction. Usually the most well-known, tried and true, and tested method to actually build wealth is not sexy, it doesn't have that sizzle factor, and it's not advertised, because it's quiet, it's slow, and it's just not as exciting. Buying the S&P 500 is like building a basic house in Minecraft. Mine might be made of oak wood and cobblestone, which is super basic and what the villagers use, but by golly, it's consistent, it's cheap, it's simple, and even a mediocre player like myself can figure it out in a relatively quick amount of time. And that house always looks decent. There's not really any risk to it, and I don't have to go die in the nether to get Blackstone to go figure out how to build a basic house. Switching gears to the most recent core curriculum article on my Substack this week, there's a personal finance guidance for every demographic except for the ones that need it most. You've probably seen Caleb Hammer on your feed, who's known as the Jerry Springer of personal finance, because he goes and roasts people for their bad spending habits, whether it's on OnlyFans or eating out or just terrible purchases like DoorDash every day. It's really quite the spectacle to watch someone's financial life fall apart in 90 minutes real time. Investopedia is another classic source, and it's technically useful. In fact, I've learned a lot from it over the years, but it's like reading a legal document written by someone's grandfather. It's just not exciting, and it's not reaching the people who actually need it. Khan Academy does have decent material buried under a layer of stuff that feels like homework, because it literally is, but that's just not as applicable as someone being on social media and actually sharing verified, consistent information. Most people are not scrolling around Khan Academy for fun. And there's a loosely connected ecosystem of 40 and 50-year-olds telling students on social media, like Dave Ramsey, ask your parents if you've never heard of him, and telling young professionals to save more money with cringy Instagrams from their beach houses or the golf course, having already made their millions, telling them to make financial decisions that just simply feel out of reach for a young person. Someone who's been working for 30 years in the best stock market and the best economy in the history of the world is just not living the life of someone who just graduated from college with tens of thousands of dollars of student loan debt. The people who are actually getting ignored are the college juniors who just made $8,000 over the summer and feels unbelievably rich. They might feel ready to blow it in just a few weeks, whether that's on DoorDash or a new car or other purchases that feel fun in the moment. Then there's the 22-year-old who made $35,000 in an internship and has no idea what to do with it other than maybe put it in a checking account or, God forbid, a Venmo account if they don't have their own banking account. Then there's the student about to file taxes for the first time, maybe underneath their parents as a dependent, or maybe individually, and doesn't know what a refundable tax credit is, let alone the American Opportunity Tax Credit, which can get up to $1,000 back in their pocket as a refundable tax credit based on how much they're spending for college, on top of the tax credit that can be applied through their outstanding tax balance. Then there's the recent graduate with their first professional job and a benefits package that might as well be written in a forgotten language. They have no idea what to do, and ChatGPT is probably going to hallucinate some crap that's going to get them fired or help them make bad decisions on their own. It's very hard for the financial industry to reach these people because they're simply not profitable. The typical advisory model is built around a fee on assets under management, usually about 1% per year, which means you need a meaningful amount of wealth for that math to work out for a financial advisor or financial planner. You'd have to have $250,000 or up to $500,000 as a minimum for them to even take an hour out of their busy schedules to talk to a client. So if you're 24 years old with $40,000 in savings, a well-paying job, and a bright future ahead of you, you're just not going to get the hands-on help that you need to actually build wealth and lay that secure financial foundation for yourself. Even if you do have a lot of potential, you're just not worth it in the moment for the financial industry. But I believe an ounce of prevention is worth a pound of the cure, and doing the right thing in the beginning rather than having to dig yourself out of a hole of debt later in your 20s, 30s, or even 40s is a better option overall. If every high school senior had it driven into their heads that $25 per week, that's just $5 per weekday, that's literally a latte, starting at graduation could compound to over $1.5 million by retirement, the next generation would have much more flexibility and security to pursue their passions earlier in life. Can you imagine working in your 30s with a job that you actually want to work instead of working a terrible job just because you need that paycheck to make your next credit card payment or to make your next car payment? It would be incredible. And what if I told you that $1.5 million could be completely tax-free? That means the government doesn't have their grubby little hands on your nest egg of savings. If you invest in a Roth IRA, that's possible, and that's what AWM Financial is working to achieve, to spread that information to as many young people as possible so that their future can be as bright and as secure as the generations before them. Personal finance isn't complicated because the concepts are hard. It's challenging because it's not a default subject in school. It's complicated because the people who create these systems don't want to share it. They want you to pay them a fee to let them understand it on your behalf, so they can go get their vacation house, fancier car, or put their kid through school with no student debt. What I'm hoping to achieve as a peer who is a rising senior in college, who is doing all the things I talk about myself in my videos, newsletter, and short clips, the $25 per week, although I technically do $50, and the Roth IRA contributions, the smarter spending through cashback debit cards and credit cards. Those are all achievable things that can be done whether or not you have a net worth of negative $50 or positive $50, not the crazy numbers that the influencers are talking about. So how does $25 a week actually turn into $1.5 million? It's through investing. If you buy the S&P 500, that's a collection of the 500 largest, most profitable companies in the United States, and sit on it for about 40 years. Yes, that's a really long time, and you have to continually keep buying. That's through a process called dollar cost averaging, or DCAing. You get to own a little slice of all those companies, and those companies have hundreds of thousands of employees who are going to wake up every morning, go to work to get their paycheck, and then make profits for their shareholders, which just so happens to be you. Over the years, those companies produce more profits and grow in value. Their share price increases, and so does your net worth along with it. As they produce more profits, they build a higher net worth for you as an investor. And by continuing to purchase shares over many decades, your net worth will grow at an average of about 10% a year based on over 100 years of historical data. By buying the S&P 500, you're not betting on a single horse to win the race. You get to own a diversified basket of stocks and companies so that not one single company can destroy your net worth. And occasionally you're going to get a really big company that grows very fast for you and carries the rest of them. But that's just diversification. Compounding does the rest. But let me give you a real life example of compounding, but against me instead of for me. A couple nights ago, I was playing a game with my friend at about 10:30 p.m. We made a pact that we would turn off the game at 11:30 and go to bed, because getting a good night's sleep is the key to having a good day the next day. To make a long story short, we did not stop playing at 10:30 or 11:30 or 12:30, but 2:30. And by doing so, I ended up getting 5 hours of sleep. It was a painful next day, and I was less productive overall, and generally didn't feel as good. Although I had a really fun time playing the game with my friend, and I wouldn't do anything differently, it is a good reminder that a small decision goes a long way over even just a day, let alone over the long run. Can you imagine if I got 4 or 5 hours of sleep every night for an entire year? It would wreck my life. I'd be less productive, less happy, and just wouldn't feel good. I'd probably come down with some illness or something. So it goes with your finances as well. $25 a week doesn't feel like much in the moment, and even over a year, it's going to slowly accumulate in the background. But over the decades, as it grows at 10% a year, it's going to start growing into a larger and larger pile that starts to build a real backbone for your finances. Enough so that one day you can retire or stop working for a paycheck. Speaking of investments, though, let me move over to my own personal portfolio and a new concept I'd like to introduce you to. DRIP. No, not water coming out of the faucet, but a dividend reinvestment plan. When a company pays you a dividend, that's them taking some of their profits and sharing it with their investors. Instead of taking the cash, you can allocate your cash to buy more shares. That means that when you wake up in the morning, your brokerage, that's the company that buys your stocks for you, kind of similar to how a bank will move around your money for you, will buy more shares for me. Last week, I woke up to $25 more of FactSet Research Systems in my Roth IRA. That's a company I've covered extensively on my Substack. Although you should never buy a company just because it pays a dividend, it does help you with total return. And FactSet has about a 2% one. That means that every 3 months, I'm going to get a check in my brokerage account, which is automatically going to get reinvested into FactSet Research Systems over the years that I'm going to hold the company, dependent on my continued research on the company. My investment in the stock will continue to grow and pay me more and more in dividends each quarter, which will get invested faster and faster to accumulate more shares, which will of course pay me more dividends. And by the time I'm older, maybe actually fully old, it'll be paying me enough to pay my bills in its entirety. Investing in individual stocks is much riskier than investing in an index fund, and I encourage you to read my articles on FactSet if you're interested in learning more. It's not financial advice, and buying the S&P 500 is generally a safer bet over the long run than individual stocks. If you enjoyed this episode, check out the other Minecraft wealth building episodes. Like, subscribe, and leave a comment with your thoughts. Next, click the first link in the description to join over 1,000 other readers of the AWM Financial newsletter, where I delve deeper on investing, credit cards, markets, budgeting, and everything related to your personal finances. Finally, remember, you don't have to have everything figured out today. Just one small positive action can impact yourself and the people around you far into the future.